I have the pleasure of sitting here next to Dr. Ron Paul. Appreciate you coming out to Dallas. This was a really fun event that we had out here, and it was a great time. Had the chance to have a nice Q&A, and you had great remarks. Didn't know you were so witty, actually.
I didn't know.
You said you had a couple of things that had me laughing pretty hard in the back. We were talking up in your room earlier and on stage here and just now about there's so many things we could talk about. Obviously, we chat about the presidential election, and we talked a little bit about things happening in investment markets and so forth. Let's talk about the Fed, a subject very near and dear to your heart. Your epic battles that you had with Ben Bernanke were YouTube sensations. I think these are great. We touched on this before. The Fed balance sheet at $4.5 trillion, and rising. They can't manage to, 25 basis points. The economy's so fragile, we can't raise interest rates by 25 basis points. I mean, what does that say about where we're at? And I mean, what is happening?
It says it's out of control, and they know it's out of control, and they don't know what to do, but they won't admit all their ideas are completely wrong. But I've been fascinated with the study of money for a long time. Matter of fact, in the 60s, I came across Austrian economics, and it was predicted that the Bretton Woods would break down. I was very impressed with August 15, 1971, when it broke down and the gold standard was dissipated, and all that came about after that. And it motivated me to run for Congress, shortly after that. But over the years, I became even more emphatic about how crucial it is to understand money in the Federal Reserve.
Right.
Although freedom is our issue, yours as well as mine, that
Sure.
really is what counts. But I would, to the Federal Reserve Board Chairman, call them the facilitator and the biggest taxer, because they facilitate big government. They always complain. The chairman always would complain. They say, well, it's Congress's fault. They spend too much money, and we have to, monetize this debt.
Right. But who gives them the money? Right.
Yeah. But if they didn't do it, Congress would have to quit. So if you don't like big government, you should not like the Fed. I mean, you're not going to have. There's sometimes a Fed will be more responsible than others, but by the very nature of this power given to control money is an obscene amount of power. And of course, the Fed and the system we have today is bigger than ever. But if you're inclined to think government should have an important role in the life of the economy and the world, you have to be for paper money, because you couldn't tax the people. What if you and I and all American citizens would have to pay enough taxes to pay for all the wars we've ever been in?
Mm-hmm.
I mean, there wouldn't be very many wars fought. So they always have to reject this. But if you want the welfare system and if you want the warfare system, you have to have a Federal Reserve, because it's a way of deceiving the people. It's a way of taxing by diluting the value of the money, and is a way of punishing one group of people, and they don't realize, and that's the middle class, while somebody else is benefiting, and that gives us some power. So it is key. I do not believe the American people can address the subject of curtailing government without the subject of how do you pay for this government. If you had a strong prohibition against inflating the currency, you would restrain government, and of course that's my goal, and that's why I emphasize the monetary system so much.
So in terms of just a complete lack of stomach to raise 25 basis points, 0.25%, they can't do it. All the Fed has is credibility. And they go and they try and convince the world that they're credible, that they're competent, that they're these smart people that are sitting in a room able to control all the dials and gears in this complex economic machine, and then they just fold.
Well, in a way, subtly and maybe not clearly for them, they are recognizing a very important thing, and that is the subjective reality of value. We could say that we know what the value should be. You print money and the prices go up, but it's not quite so simple. There's a subjective element. The subjective theory of value depends on people's mindset. So they recognize this, and they're psychologically saying, well, the history shows that if you send this signal, the people might do this, and they get annoyed because they can't control how the people react to what they do. So they are actually accepting the fact that it's the bad signal. It shouldn't be. It seems ridiculous. If you want to talk about a bad signal for somebody that knows about economics, it was way back when. It was way back in 1971 when we knew that as soon as there was no restriction on the printing of money, there would be an explosion of money. And look at the charts from 71 on. Whether it's standard of living or cost of living, the price of gold, and employment statistics, there's definite spot. August of 1971, it was a day that told us what would happen. And of course, the climax of that is, I think we're in the middle of the climactic end of that system, and it will end because I think a big adjustment occurred. Well, a significant adjustment occurred in 2000, and then a much bigger one in 2008 and 9. And they miraculously, in a way, were able to tinker again and restore this confidence, but they're scared to death that this 0.25% is going to shake the country. That tells you, I think it tells you
how fragile
the whole thing is. That if it's going to come down because of 0.25%, that's why that tells you that this system is built on a foundation of sand.
When you were at our event in Chile a couple of years ago, and you're talking about a lot of these things, how would you kind of summarize from the last time you came and chatted with us in Chile to where we are today? It's been a little bit more than 2 years. How would you sort of assess what's happened economically, financially over the last 2 years?
Well, the stock market's gone up, and that's one measurement of the health of the economy by the Fed. And
do they really consider the stock market to be the reflection?
Well, yeah, that's their. They are the plunge protection team.
Sure.
So no, if stocks weren't kept up, that again would be another signal of the fragility. It's the President's Working Group on Financial Markets. Reagan, the big conservative, he gave it to us with an executive order because right after the '87 crash. So no, and then
the whole idea to prevent major crashes in the stock market.
And it's been nicknamed on Wall Street the plunge protection team. Yeah. They know it's there, and they know it's there. And even if you're on Wall Street and a trader, on your day-to-day trade, you might be a free market buy. And they might agree a lot with what we're saying, but they're still, their antennas are up for what's the market reaction going to be. And the plunge protection team says that low interest rates are the key to it. But now they are totally addicted to low interest rates. And the reason why that is so important, people don't understand it, it's manipulating the most important price you can have in a free market economy, and that's the market price of interest. And that tells you about savings, how much true capital is available. And so it totally erases it. We know that if you put wage and price controls on, which I remember clearly in this 1971, the markets went like this, shortage and everything immediately. But here we live with price fixing of interest rates, which means they manipulate the value on a day-to-day basis of capital, by fixing these interest. And that's a participant. That's one half of every transaction on everything that we do is jerry-rigged by the Federal Reserve, and that is why you get. People, the Fed says, like Krugman would say, Ron Paul doesn't know there's no inflation yet, and this sort of thing. But even if prices aren't as going up as much as he's criticizing me for, it's the malinvestment, it's the misdirection of capital that is more important. Too many houses or too many hotels or too many oil wells. Just think of the oil thing. Price of oil was good. That was an inflationary factor. There's a shortage. The price of oil's up. So the easy credit by the Fed, because and they have a new source of energy in the bubble, and then they couldn't control it. The thing finally burst, and so manipulating that and the malinvestment. Most people, you never hear the Fed worrying about malinvestment. They worry about if there's overinvestment, how will we protect them? But the housing thing got out of control, and they couldn't protect them. But they always think that they can protect them, and even the people on the other side know that the Fed have places where it's not going to be perfect. So they want to deal with that with regulation. So the Fed does this. It still won't be right because the market's not dependable. But if we regulate, and that's why every time you have a setback, they give more power to the Fed. Just look at, there was Sarbanes-Oxley, there was Dodd-Frank,
right.
There was the SEC. Every time you have more, and now we're inundated, and that's why we have no growth, and that's why structurally unemployment's just horrible. The labor participation rate is at record lows.
Right.
And that's why we're poorer too.
I have this view that you could take kind of the bubble history back to you had the dot-com bubble in the 90s, and then we kind of had a housing bubble. The housing bubble turned into a banking bubble. The banking bubble turned into a sovereign, really a government bubble, as we see these things bursting in Greece and Cyprus and Ireland and so forth. I think sort of the bubbles keep matriculating a little bit higher up the food chain. You end up with now. I think the bubble in central banks, and I think at the end of the day, you look at the Fed publishes its balance sheet every week. The H41 report comes out is now the Fed's assets as a percentage of the Fed's net equity as a percentage of its deposits, as a percentage of its assets. Its equity as a percentage of its assets is 1.3%. This is just amazingly low. And what's interesting is that when the Fed raises interest rates, they're essentially reducing the value of their own bond portfolio, essentially causing their own insolvency.
And that's all part of the bond bubble. I think that's the very, very big bubble, because the price of bonds are very high. Yeah. And they think the only way that is going to break is the Fed raising interest rate by 0.25%. But I don't think they're going to do that. That's the position I've taken.
So you don't think they're going to raise interest rates?
No, I've said that for years, but that doesn't mean that they won't. But I just think there's pressure on them not to, because they're terrified, of what they might get blamed for. So,
do you think they'll go negative?
Oh yeah, I think they would do that. I think, but they don't want to be responsible for raising rate. But what they don't realize is rates can be raised by the marketplace and overpower the Fed.
Right.
What happens if...
Bond market's bigger than the Fed.
Yeah, what happens if there's an acceleration of the selling? China's selling a few of their bonds right now, and somebody's buying them, and they will wheel and deal and get Belgium or somebody to go in there and extend them credit and buy these bills to do it. But eventually, the truth will come out, and interest rates will go up, the value of the dollar will go down, and then I think it'll be a rush to the exit.
So if there's people out there that agree with this view, what do you think is the most appropriate thing for folks to do? What's the kind of action to take?
Well, you have to do several things, and everybody won't do the same thing.
Sure.
I think understanding the problem, which means studying and understanding, know what economics are all about, so that we can answer the question of people who might be interested in what we're talking about. So I think that's important. But I think protecting oneself and protecting one's family is crucial.
Sure.
And that means investments, and they can be simple, they can be sophisticated. We know historically that the precious metals have been a protector. But ultimately, when I get down to it, for me, the bottom line is none of it works if you don't have your liberties. You can have a gun in your house and gold in the basement, and you may, people. There will be some, but not everybody can have a safe haven somewhere, even hiding in the United States or overseas. So for me, it's trying to, and for me, it's almost like a mission to wake up a generation of young people so that we can get that 8% of people who will lead our country in a different fashion. And so many people get discouraged. How are you going to get 51%? You can't get 51% in the Congress to agree to anything. But if you get the leadership, as the leadership of our country in economics and education and things, been teaching all those congressmen, they're all Keynesians. They all believe in this stuff. Right. So I think that is it. That will, long term, that's the most important thing to do. But I believe in the short term, and preparation, and everybody's preparation will be different.
Sure. There's no one-size-fits-all solution. All the circumstances are different. But you make a great point. I mean, the most important thing I think that applies to everybody is that knowledge and education. There's no substitute for that.
That's
You
right.
can't solve a
Because
problem unless you
that'll
understand
help,
it.
That'll help determine what you do. Because if you think that the current foreign policy and economic policy and monetary policy just needs tinkered with,
Right.
and a lot of people think that.
Sure.
Just a little bit
Just
different.
turn the
management.
dials a little bit.
Yeah, I
Yeah.
agree, Ron. We're in too many places overseas, but we just need somebody managing this other than Obama.
Right.
It's just that kind of thing. Oh yeah, government in medicine is okay. Republicans agree with that. They've done enough of it, but we don't need Obama doing it. It's that kind of stuff. They actually believe that they can patch things up, but it's not. I keep thinking that one of the best analogies of prolonging government interference was the position that we had on the gold from 1945 up to 1971. And we essentially gave away 500 million ounces of gold and say, no, we're going to honor the dollar as convertible to gold at $35 an ounce. And then finally, somebody said, Nixon says, no, we can't do it anymore. We have to admit that we failed, and they close it and they cling on to the remnant of their gold. No, they eventually the markets went out, and that's what's happening. Is a big struggle right now. The markets demand deflation, and governments demand inflation.
Right.
And right now we see areas where the deflations are there. Debt does get liquidated and all, but the market will deflate the whole system. But the recovery will depend on what the politicians do and how much liberties we have and what they do with the restoration of a sound currency, what they do with the tax code and the regulatory system, and whether or not people will ever come around to believe once again that self-reliance is good and better than anything the government could ever give us. People still have confidence the government will take care of them, and the people who need something, they're entitled to it, and that has to change.
Ron, it's a great way to end this. Got a lot of folks waiting outside. I know want to get a picture with you, so let's go out there and join them. And thanks for joining us here and for the conversation.
Sure thing.